Hello and welcome to GoldCore TV. I'm Dave Russell and my guest today is Ronni Stoferle of Incrementum. Incrementum is an independent investment advisory firm and the producer of the highly respected In Gold We Trust report. And as well as being a partner at Incrementum, Ronnie's also an advisor for Tudor Gold and a member of the advisory board of Affinity Metals and an advisor to Matterhorn Asset Management as well. And Incrementum have just published and released a new report, and it is entitled The Boy Who Cried Wolf: Is an Inflationary Decade Ahead? Welcome, Ronni, and thanks for joining us today on GoldCore TV.
Hi, Dave. Thanks for having me.
Now, why are you suggesting that now specifically is different, and that now, when the boy is crying wolf of inflation, that he's actually telling the truth?
Well, the thing is about this story about this boy who cried wolf. He cried twice and nobody cared about it, and then at the third time, actually everybody thought that's a joke and he's just kidding. But then actually the sheep were attacked by the wolf. And from our point of view, many analysts, many strategists were warning of inflation already after the great financial crisis, and actually it didn't really materialize, but we could say that it to some degree it did materialize. It materialized in the form of asset price inflation. But now it really seems that there's quite a significant paradigm shift happening. I think we're at the end of this 40-year disinflationary or deflationary paradigm, and we are moving into a new inflationary paradigm. And I think the main factors driving that is, first of all, that we're seeing this move from monetary QE to fiscal QE. So in this crisis, we saw that there were very aggressive monetary measures, but the fiscal measures were even more aggressive. So in Western Europe, for example, it is 30 times larger in today's money than the Marshall Plan. So it is really enormous, unprecedented amounts of fiscal stimulus that we saw. Then we're seeing this move in the United States, but probably also at some point in the Eurozone, to average inflation targeting. And as inflation numbers were undershooting over the last couple of years, now the central bankers are very vocal and they're very open about it. They want inflation rates to overshoot over the next couple of years. Then we're seeing now that also the broad monetary aggregates are rising significantly. M2 is rising at almost 30% in the United States, at 26% in the Eurozone, significantly faster than, for example, in the highly inflationary 1970s. And we should not forget, inflation-sensitive assets are already telling us that inflation is around the corner. It is no coincidence that gold is rising, that silver is rising, that Bitcoin is rising, that inflation-protected bonds are rising, that commodity currencies are rising, and that the US dollar is down significantly. So I think the market is already discounting inflation. And from my point of view, from a political point of view, MMT is now really becoming mainstream. And this is something that...
So by MMT, you mean modern monetary theory, yes?
Yeah, or the Mugabe-Maduro theory of money, or as Dave Rosenberg called it, the magical money tree. So I think those are all trends that are accelerating, and we shouldn't forget that there's a strong deflationary pressure still in the market. We're seeing if there should be a default wave coming up next year, at some point we will see a higher amount of defaults. This would be deflationary, of course. We're seeing lots of capacity that is also kind of deflationary. We're seeing demographics is deflationary. But on the other hand, we're seeing this strong political trend to deglobalization. We're seeing that, of course, the debt levels that were already quite high before COVID hit us. They are now even higher. And I think people cannot comprehend those levels anymore. So from my point of view, the case or the desire for higher inflation rates is bigger than ever. And the fear of deflation is also bigger than ever. So what does it mean for us as investors? You can say goodbye to rising rates. We should get accustomed to deeply negative real rates over the next couple of years, and this should provide a pretty positive environment for the price of gold.
And when you talk about the change in the Fed inflation targeting, you also mentioned in the report, and I quote here, the most significant inflationary development of 2020 could be the recent policy shift surrounding the money creation process. What specifically are you referring to there?
Well, actually, I think let's call it a reverse Volcker. Paul Volcker, his job was basically at the end of the 1970s, beginning of the 1980s, to kill inflation, to implement radical measures to finally break the bones of inflation. Now we're seeing this reverse Volcker, where central bankers all over the globe are really desperately trying to get inflation numbers up. And I think that, first of all, the definition of inflation is definitely different. Austrian School of Economics that I adhere to compared to the mainstream view. But I think that the fact that now the Federal Reserve is openly saying, well, inflation rates were undershooting over the last couple of years, and as soon as we hit 2%, then there would be pressure coming from financial markets to raise rates. But now with this average inflation targeting at 3, 4, 5%, we can say, well, on average, we're still fine and we don't have to raise rates. So I think this is really a fundamental shift that we're seeing in markets. And the big question, of course, is how will markets respond at 3, 4, 5% inflation rates? And we will hit those levels approximately in spring because of the base effect, because of all the developments that we're already seeing. I think, there will be inflation surprises. And the big question is, first of all, what will equity markets do at 3 or 4%? Because this comfort zone for equities is between 1 and 3%. Once we go above that level, equity investors tend to become more nervous. And then, of course, the biggest question of all is, how will bond investors react? And I think if inflation really becomes a concern for investors, I think, of course, the natural reaction will be by the oldest inflation hedge that is around. And we know which one that is. But on the other hand, if we should really see an exodus from the bond market, and just to give you one number, at the moment there's $18 trillion invested in negative yielding bonds. I think this is really going to be the big driver for the next leg in the gold price, because now I think that many institutional players, we saw like inflows of roughly 1,000 tons into gold ETFs. We are seeing that gold is becoming, let's say, part of the strategic asset allocation again, because you don't have to be a market wizard to understand that, we won't see significantly higher real rates. So I think it's becoming normal again to have a certain amount of gold as a strategic portfolio hedge. And I think this trend will accelerate once inflation really becomes a concern and once we see this exodus from the bond market.
We've got Biden taking over, the Biden administration taking over towards the end of January, the White House. And we can probably expect some strong future stimulus there. How do you think that the future stimulus will impact on inflation, monetary inflation?
Well, if you have a look at the age of the most important politicians in the U.S. in the new administration, I wouldn't expect too much reforms. I would expect more of the same. And I think with Janet Yellen now being nominated as the head of the Treasury, I think the symbolic character is cannot be understated. I think it's a very, very important sign that is telling us, well, this cooperation between monetary and fiscal stimulus, this flirt that we have seen between monetary policy and fiscal policy, this is now becoming one. They basically got married in 2020, and this is a very, very important change that we saw. Now, of course, Joe Biden, first of all, I think that MMT, as I've said before, is becoming more important. Stephanie Kelton, she wrote The Deficit Myth. Of course, MMT is the new big thing. Unfortunately, it's a very flawed economic theory, but I think this is really becoming mainstream. I don't expect a big turnaround when it comes to government debt to build back better. He needs very, very low capital costs. So at some point, I think if the bond market should get nervous, I think some sort of yield curve control will be implemented. So, as I've said, this in combination with higher inflation expectations, this is basically the perfect storm for gold.
And I quote from your report again, you say, the wolf of our global economy is practically howling at this point, but nobody seems to be taking notice yet. How and where specifically are you identifying this inflation, and why is it that nobody's paying attention to it?
Well, I think first of all, because many strategists already warned of inflation in the last couple of years, and it didn't really materialize. On the other hand, I would say, if I look at house prices, if I look at insurance costs, social security, if I look at just taking your family for dinner, I don't have the big deflation scare, I would say. I don't think that everything became super cheap. But of course, if you follow those government statistics, then there hasn't been any inflationary pressure so far. But I think inflation always is a process, and I think we have laid the foundation for future inflation already over the last couple of years. Now, I think the main driver going forward is velocity of money, and I had a conversation.
What specifically do you mean by velocity of money?
Well, velocity basically describes the turnover of money in our economy. Now, the Austrian school is a bit critical of the concept of velocity. They call it the demand to hold money. But what it basically means, I think that the main problem that we're having at the moment in this crazy year of 2020, nobody does have any confidence. So it is like driving in your car at night when it's raining, when it's foggy, when it's perhaps icy. So you have to drive very, very slowly to not risk anything. And if I talk to other business owners, to investment managers, of course, nobody is making any big investments. Nobody is making any big plans for the next year. I mean, travel plans. Who knows what the next year will bring? But I think with the vaccine, I think this confidence will slowly come back. And from my point of view, people will be able to plan more again, to make investments, to consume, to go out, to go on vacation. I think actually, I don't believe that it's that everything will be completely different to the pre-COVID time. I think people will go nuts. They will go crazy. They will party. They will, travel as much as possible. They will, go out for dinner. as much as possible, at least at in a certain time. Then perhaps they will realize that they are broke. But I think that once the velocity, so this turnover of money starts rising, and at the moment we're already seeing that it's stabilizing, we will see that this enormous amount of liquidity that was created by central banks and by fiscal stimulus, it will hit rising velocity, and this is the recipe for inflation. So I said in an interview recently, well, actually, as a central banker or as a politician, now would be the time to reduce the stimulus, because they underestimate the time lags that are involved. It's like with drinking whiskey or tequila shots. Yeah, at the beginning you think everything is fine, and then a couple of shots later, well, the effects really kick in. So, but and of course, no central banker will now say, well, we did our job. Now let's go back to capitalism and to free markets. So from my point of view, this is really another ingredient. Rising velocity will be another ingredient for rising inflation.
And finally, then, if we ignore the inflation wolf that the boy is crying about, how is this going to impact a typical investment portfolio? And what's the best thing that we can do now?
Well, actually, as I've said, I think financial markets are already smelling and seeing inflation on the horizon. So gold and silver doing well, silver particularly doing well. Very, very stable throughout the whole gold correction that we saw over the last couple of months. Inflation protected funds already telling us that inflation is becoming a concern, but it is not a big topic yet. And of course, if we should see this shift, and let's face it, the average investment advisor at the moment is 50 years old. So he never dealt with a highly inflationary market environment. So it will, many market participants will be, how do you say, caught on the wrong foot. And this is something where I think, if you study asset managers from high inflation countries like Brazil, like Turkey, for example, for them it's just more natural to care about inflation. It's actually one of the most important drivers for your portfolio construction. And I once did a couple of presentations in Istanbul, and I have to say the questions asked from Turkish investors were the most the smartest and the most sophisticated questions that I ever got asked, because they know about gold, they care about gold, and for them it's just natural to have a portfolio hedge. So I think it will create a dramatic shift in portfolio allocation. I think, if inflation really is a concern, cash isn't the best idea. I think that bonds, most of the bonds, aren't the best idea either. When it comes to equities, it clearly depends on the sector. And we crunched the numbers in our report, and we said, okay, those are the drivers that or the factors that you have to take care of. Does the company have pricing power? If not, then they will probably suffer in an inflationary environment. And of course, hard assets are one of the main beneficiaries of an inflationary or stagflationary environment. Gold, silver, cryptocurrencies, Bitcoin. I think that real estate could do okay. I think that commodities in general should do very well. So those are basically the investments of choice in an inflationary or stagflationary environment.
Ronni, thank you very much for that. What I'd like to do is I want to recommend that everybody reads the report, The Boy Who Cried Wolf, Is an Inflationary Decade Ahead. I'm going to put a link to that report beneath this video, and you can download it from there. There'll be a link through to Incrementum's website, and you can download it from there. I highly recommend that everybody reads this. It is recommended reading for the times that we're in. So I'd just like to thank again my guest from Incrementum, Ronni Stoferle. Thank you very much.
Thank you very much.
Thank you. And finally, just to remind everybody to subscribe to GoldCore TV, hit the subscribe button and the notification bell, and you can stay up to date with all things precious metals on our website, goldcore.com. For me, Dave Russell, see you next time.